Dollar cost averaging. The strategy that beats 99% of investors. What if I told you the worst time to invest is actually the best time to invest? Most people think they need to time the market perfectly. Buy low, sell high, right? But here's the thing. Even Warren Buffett can't do it consistently. Yet there's a strategy so simple, so powerful, that it has mathematically beaten 90% of active traders over the last 20 years. It's called dollar cost averaging. And honestly, it's probably the only investment strategy you actually need. I'm about to show you exactly how it works, why it works, and how to start today with your actual money. Let's go. Part 1. The simple truth. Dollar cost averaging is ridiculously straightforward. You invest the same amount of money at regular intervals, no matter what the market is doing. That's it. Let me give you a real example. Let's say you decide to invest $500 every single month into the S&P 500 through a Roth IRA. January comes around. You put in $500. February, another $500. March, $500 again. The market crashes in April? You still invest $500. It skyrockets in May? Guess what? Still $500. You're not trying to catch falling knives. You're not waiting for the perfect entry point. You're just consistently feeding money into the market, automating your wealth building. Here's why this matters so much. In 2020, most people were absolutely terrified. COVID-19 hit. The market dropped 34% in like 3 weeks. Stocks were on sale. But do you know what most investors did? They panicked and sold. Or they froze completely and missed the recovery. But someone doing dollar cost averaging? They kept investing $500 every month through that entire crash. They were buying stocks at the lowest prices in years without even thinking about it. The market recovered. By the end of 2020, it was up 28% from where it started. Those people who kept investing, they were buying more shares per dollar because prices were lower. Then the recovery printed them money. That's the psychology hack that beats 99% of investors. You remove emotion completely from the equation. Part 2. The math proves it. Let's look at actual numbers because this gets even better. Say you're 25 years old and you commit to putting $300 every month into an S&P 500 index fund. Through your Roth IRA, that's through Vanguard, Fidelity, or wherever you have your account. $300 times 12 months equals $3,600 per year. Over 40 years until retirement at 65. That's $144,000 of your money going in. Now here's where it gets insane. The historical average return of the S&P 500 is around 10% annually. With compound interest doing the heavy lifting, that $144,000 grows to roughly $1.4 million. $1.4 million. And you didn't have to predict a single market move. You didn't have to be smart. You didn't have to read earnings reports or follow CNBC. You just showed up and invested consistently. Compare that to the person who tried to time the market. They had the cash ready in 2008 waiting for the perfect bottom. Except they kept waiting. They bought a little bit in 2009. They sat on the sidelines in 2010. They got back in during 2011. They panicked and sold in 2018. And they missed huge chunks of gains trying to be clever. That person maybe turned their $144,000 into $600,000. Half the returns. For 10 times the stress and energy. Part 3. How to start right now. Here's exactly what you do today. First, pick your vehicle. If your employer offers a 401k match, max that out first, it's free money. Then open a Roth IRA if you don't have one. Fidelity and Vanguard are solid. The fees are low. The interface is clean. Second, set up automatic investments. This is critical. You want your money moving without you thinking about it. Go into your brokerage and set up an automatic transfer every single month. I recommend doing it right after payday so you don't miss it. Third, invest in a low-cost index fund. For 90% of people, that's an S&P 500 index fund. It tracks 500 of America's biggest companies. You're buying the entire market basically. On Fidelity, look for FSKAX. On Vanguard, it's VT-SAX. These have expense ratios under 0.05%. You're not paying to play. Fourth, and this is important, ignore the news. Seriously, when the market drops 20%, your feed is going to fill with doomsday headlines. Ignore them. You're dollar cost averaging. Down markets are good for you because you're buying cheaper shares. Set it and forget it. Check your account once a quarter at most, not every day. Not every hour. The bottom line, dollar cost averaging isn't sexy. It's not a get-rich-quick scheme. It's the boring, consistent, mathematically proven way that regular people build actual wealth. Millionaires are built on this strategy, not on crypto picks and hot stocks. You have everything you need right now. You have the knowledge. You have the apps. You have the ability to start today. The only question left is, are you actually going to do it? If this video helped you understand how to build real wealth, smash that like button and subscribe because we're dropping videos every single week on the strategies that actually work. Your future self is watching right now. Don't let